Can you describe the differences between STRD, STRK, and Strife for investors?
Strife, you can think of it as like investment grade, safe, low volatility debt instrument. It's severely over collateralized. If in the case of a missed debt payment, your interest rate goes from 10 to 11% and then 11 to 12%, and it's cumulative. So any interest they miss, they have to pay later. So there's all these protections in place. Meanwhile, STRD is basically similar to Strife with all of the protections stripped out. So it's non-cumulative. They don't have to pay the dividend. STRD is junk debt. And someone, you might say, why would you ever buy junk debt rather than investment grade debt? Well, junk debt pays you more. They're both 10% at par value, but Strife will probably pay you, 7, 8%. STRD will pay you 10%. Strike is in the middle of those two. Strike is, they call it a Bitcoin with a fellowship. You get Bitcoin exposure because there's a conversion. There's a call option, right? It's like you have a bond and then you have a call option on MicroStrategy for 100 years and they're combined, right? So the interesting thing with Strike is, if you go on Robinhood or your TD, Ameritrade app or whatnot, and you click on the options for MicroStrategy, $1,000 call option for next year is like actually pretty pricey. 1 year out, it's a volatile stock, anything can happen. Strike takes, it's a $1,000 call option that never expires. It's perpetual. So it takes, a fixed income instrument that pays you 8% combined with a call option. There's something for everybody. Do you want higher risk, higher yield? STRD. It's at the bottom. It's the most risky relatively. Do you want a yield with performance that's linked to Bitcoin and MicroStrategy? Strike is really attractive. Do you want safe, boring, low volatility, high margin of safety? That'll be Strife.
Do you think the market is really missing what's happening here?
Really, most debt instruments are based on, the expectation of future cash flow, not asset-backed. Strategists said they're trying to really create a new theory of credit. We're going to create asset-backed credit instead of cash flow-backed credit instruments. That's the mission. It's an exciting one. I think 10 years from now, 20 years from now, financial historians will look back and say that was an inflection point in Bitcoin and the rise of something that we all agree now was inevitable. But right now, it flies in the face of conventional, traditional, wisdom.
It really does. And there are many trillions to go after in the fixed income market.
Many trillions, hundreds.